Understanding the difference between public and private markets is essential for investors navigating the diverse landscape of investment opportunities. Public markets refer to exchanges where securities of publicly traded companies are bought and sold. These exchanges, like the New York Stock Exchange, NYSE, or NASDAQ, offer liquidity and transparency, allowing anyone to invest in stocks, bonds, or ETFs listed there through brokerage accounts. In contrast, private markets involve investments in assets not traded on public exchanges. This includes direct investments in private companies, venture capital, private equity funds, and real estate partnerships. Transactions in private markets are negotiated directly between investors and private companies, often with less regulatory oversight compared to public markets. Regulation plays a significant role in distinguishing these markets. Publicly traded companies are subject to stringent regulations set by securities regulators like the SEC in the United States. They must disclose financial information regularly to ensure transparency and protect investors. In contrast, private investments face fewer regulatory requirements, offering companies more flexibility but often requiring accredited or institutional investors due to higher risk profiles. Investment characteristics differ as well. Public markets provide liquidity, allowing investors to buy and sell securities easily. Prices are determined by market demand, leading to price volatility influenced by economic conditions, company performance, and investor sentiment. Private markets, however, lack liquidity as investments are not traded publicly. Exit strategies typically involve longer time horizons and depend on company growth or specific liquidity events. The investor base also varies significantly between public and private markets. Public markets attract a broad range of investors, from individual retail investors to large institutional funds and hedge funds. Private markets, on the other hand, typically cater to accredited investors or institutional investors due to higher minimum investment requirements and risk levels associated with private investments. Valuation and transparency present another distinction. Public market valuations are readily available and reflect current market sentiments and company performance. Investors can assess valuations based on publicly disclosed financial statements, analyst reports, and market benchmarks. Private market valuations, however, can be more opaque and complex, relying on appraisals, industry comparables, or valuations provided by investment managers. Both markets offer unique advantages and considerations for investors. Public markets provide liquidity, transparency, and access to a wide range of investment options, making them suitable for diversified portfolios. Private markets offer opportunities for higher potential returns, especially in early-stage companies or alternative investments, albeit with higher risks and longer investment horizons. In conclusion, understanding the differences between public and private markets is crucial for investors seeking to optimize their investment strategies. Whether pursuing liquidity and transparency in public markets or exploring growth opportunities in private markets, aligning investments with financial goals and risk tolerance is essential for long-term investment success.